The next financial crisis won't look like 2008. Asterisk, if you're waiting for the next financial crisis to look like 2008, you're going to miss it. Most people think crises come with obvious warning signs. Banks collapsing, stock markets crashing, overnight, panic on the news. But history shows something different. The next financial crisis won't look like 2008. It won't be obvious. It won't feel the same. And that's exactly why it could catch people off guard. Let's break this down. Asterisk, 2008 was a banking crisis. The next one may be a confidence crisis. Asterisk, the 2008 financial crisis was rooted in one core problem: the banking system, subprime mortgages, toxic assets, leverage stacked on leverage, banks lending money that didn't really exist. When housing prices stopped rising, the whole structure collapsed. But today, banks are more regulated, capital requirements are higher, stress tests are routine. The financial system, at least on paper, is more stable. So if it's not banks, what could it be? The next crisis may be a confidence crisis. Confidence in government debt levels, currency stability, asset valuations, artificially inflated markets, AI-driven bubbles, or even geopolitical stability in 2008. The problem was hidden inside balance sheets. In the next crisis, the problem may be hidden inside expectations. And expectations can shift overnight. Asterisk. The debt problem is bigger, but different. Asterisk. In 2008, household debt was the main issue. Today, the bigger risk may be sovereign debt. Governments around the world have accumulated record levels of debt. Interest payments are rising as rates stay elevated. When borrowing becomes more expensive, the pressure shifts from consumers to governments. If governments struggle to finance debt, taxes may rise. Spending may be cut. Markets may panic. Unlike 2008, this wouldn't start with homeowners. It would start at the top. And when governments tighten, it trickles down fast. The warning signs won't be foreclosures. They'll be budget deficits, bond yields, and currency volatility. That's harder for the average person to recognize. Asterisk. Asset bubbles don't always look like housing. Asterisk. In 2008, housing was the bubble. Today, it could be tech valuations, AI stocks, private equity, commercial real estate, crypto, or even passive investing concentration. When money floods into one area for too long, risk builds silently. The difference today is speed. Information spreads instantly. Trading happens algorithmically. Panic can move through markets in seconds. The next crisis might not unfold over months. Like 2008, it could cascade in days, or even hours. Asterisk. The labor market could be the wild card. Asterisk. One major difference between today and 2008 is automation and AI back. Then, job losses were tied to construction and finance. Now, entire white-collar sectors are at risk of disruption. If AI reduces hiring demand or reshapes industries quickly, we could see wage stagnation, reduced job mobility, income inequality, widening consumer spending, weakening, and, when spending weakening, growth slows. But unlike 2008, it wouldn't feel like a sudden collapse. It would feel like a slow squeeze. People wouldn't lose homes overnight. They'd feel stuck, stagnant, uncertain. That kind of crisis doesn't make dramatic headlines, but it erodes wealth quietly. Asterisk. Liquidity is different now. Asterisk. In 2008, liquidity dried up. Banks stopped lending. Credit froze. Today, central banks are far more aggressive. They've shown they're willing to inject liquidity quickly. That means the next crisis may not look like collapse. It may look like distortion. Markets may not crash 50%. Instead, we could see persistent inflation, asset price manipulation, currency devaluation, increased wealth inequality. The crisis may not destroy markets, it may reshape them, and those who don't understand what's happening could fall behind without realizing why. Asterisk. The psychological trap. Asterisk. The biggest danger. Fighting the next crisis using the last crisis playbook. In 2008, the smart move was survival. Cut debt. Build emergency funds. Avoid leverage. Diversify. Those principles still matter. But if the next crisis is inflation-driven, debt-driven, or currency-driven, the strategies might shift. Holding too much cash could hurt. Ignoring skill growth could hurt. Relying on one income source could hurt. This is where growth meets crisis. The next financial shock may not reward pure defensiveness. It may reward adaptability. Asterisk. What this means for you. Asterisk. Instead of trying to predict the exact trigger, focus on resilience. Ask yourself, if inflation spikes again, am I protected? If my job changes due to automation, do I have leverage? If markets drop 30%, can I stay calm? If opportunity appears during chaos, do I have liquidity to act? Crises create two groups: those who panic, those who prepare. In 2008, some people lost everything, others bought assets at generational discounts. The next crisis won't send the same warning signals. It may look like a sudden market rotation, a government debt scare, an AI bubble deflation, a currency shift, or a slow economic grind. But here's the key. Financial crises don't destroy wealth. Unpreparedness does. Asterisks, asterisks. The opportunity side, asterisks. Every crisis shifts power. Every crisis transfers wealth. Every crisis creates new leaders. After 2008, tech giants surged. Real estate investors who bought early built fortunes. Passive investors who stayed invested, recovered, and grew. The next crisis will also create winners. But the winners won't be the ones waiting for a 2008 replay. They'll be the ones watching. Debt trends, liquidity cycles, technology disruption, global capital flows. The form changes, the pattern doesn't. Excess gives correction, gives reset, gives growth. Asterisk, asterisk. Final thought, asterisk. The next financial crisis won't look like 2008. It won't be obvious. It won't announce itself loudly. It may feel gradual, until it isn't what it is. It's. The real question isn't when it happens, it's whether you're building resilience before it does. Because the next crisis won't just test markets, it will test adaptability. And the people who grow through it won't be the ones who memorize the past. They'll be the ones who are prepared for a different future.